Should we buy or sell the S&P 500? First off, read this disclaimer carefully. And do your good deed of the day by liking and subscribing. So we will look at a very interesting S&P 500 ETF, which is equal weight, and it is the RSP, 2.22% away from the 52-week low, minus 14-ish% pullback. When we look here at the SPY ETF, we see that it is 19% away from the 52-week highs. So very close to, the minus 20% definition of a bear market. So here is the RSP. The great thing is that we also get data from, the global financial crisis. So a key thing here is that, this is in 2007, and you can see that this blue 100-week moving average, it was, a very key support level. So let me draw it in, very key here. It was very tradable, but then we saw a change where the blue 100-week moving average became a resistance level. And it was after that attempted, recovery rally, with that clear rejection, that is when it became very official that we really were in a bear market. So don't get too hung up in this whole thing about minus 20% or not. The key thing is, the ultimate sign of a bear market is that the recovery rallies fail. That is where it is very clear that it's not simply a correction, it's not simply just a plunge, it is actually a full-bore, longer-term recession. So here we zoom out, zoom closer to our current time, 2009, the 100-week moving average, clear support, very buyable. In 2011, we had a lot of uncertainty. Here, very buyable, fantastic entry opportunity. Here it becomes resistance. Here it is almost surgical support. So obviously, the blue 100-week moving average, it is a big, big, big deal for the RSP. Obviously, there's many people who are using it. So this is our current setup. So the blue 100-week, it has recently been, back here, a resistance level, but it's also been very clean support, fantastic buying opportunity. Interestingly, we are now testing that moving average. So the primary assumption is that, this is an opportunity for the bulls, and as long as we are above that moving average, you could lean a bit bullish. But that would be speculatively bullish because, as we have seen, looking at the previous major bear market, is that moving average, it can become resistance, and that is when it is very clear that things are very bad. We do have a rounding top pattern here on the RSP, but a rounding top pattern, they are shaped, like this, like that. So there are rallies even as a rounding top is formed. Given how many weeks in a row we have seen us close lower, 1, 2, 3, 4, 5, 6, 7, that's substantial. So if you just go back here to the global financial crisis and do some counting, here as an example, you have 1, 2, 3, 4. Here you got 1, 2, 3, 4, 5, 6. Then you even during the financial crisis, you had a rally. Here, okay, let's count 1, 2, 3, 4, 5, 6. Then you got the bounce. So even if this current time frame, our present, is a full-bore, horrendous bear market, we expect a bounce at least. And this is a moving average that has been supported in the past, so yeah, I am going to lean bullish. Looking at the daily data points, obviously we do have a downtrend, but we have a protracted downtrend. So from a risk-reward standpoint, it's not safe either to initiate new short positions at these levels. If you were a short from around here, these tops, that's fantastic, of course, and you have a good gain, probably some trailing stop. But now, you could even argue that you have something, it's not like a roaringly bullish double bottom, but this here, it is a bit double bottom-ish. Okay, so let's look at these other indicators, like this. Okay, so looking here at the RSI, now the vast majority of times, going all the way back here to 2003, the current RSI, it has a tendency to trigger bounces. We went lower during the worst part of the global financial crisis in 2008, so it is possible to go even lower, and also during the lockdown, then we did plunge far lower. But a large number of times, occurrences at this level, we bounced. So let's go back here to 2018 as an example to see what happened then. So you see here, this is the almost precise RSI level we have now, and then we did get the bounce. We did get the bounce that failed, but at least we got a bounce. We did eventually go lower, and when we touched, that threshold level of weekly RSI, that is where it formed a key low. Here is 2016. Yeah, this current RSI level triggered a bit of a bounce. Back here as well, a bit bouncy. So yeah, I mean, I think there's also, when we go here to the daily data points, looking at MACD, RSI, and the PPOs, we are at a level that has a tendency to at least trigger a bounce. So here is the laboratory. So I think the line in the sand is 100 WMA support. I think that's the key thing. I could also argue plus RSI. As far as giving the technicals a bit of a rating, I do think that this is a key level. The only problem is that we have tested it multiple times now without really getting more than the plunge protection team getting into action. So I think I will give the bulls here, I give them a 3. Here is the seasonality for the RSP. Looking here to the right, we get the average data. The seasonality is bullish over the last 5, 7, and 10 years. Looking to the left, over the last 5 years. May, the current month, it closes higher 60% of the time. June and July are the strongest months over the last 10 years. May closes higher 80% of the time, so definitively you could make a strong case that the bulls, they do have an edge. June is not too shabby either, and July is one of the strongest months. Then big picture, the last 20 years, May does close higher 70% of the time. June is actually one of the weakest months. So based purely on the seasonality data, I do think I will give the bulls. I think I will give them 5 here. I mean, the current month is just strong for the RSP. So let's compare the RSP, which is the equal weight S&P 500 ETF, which means that the components here have equal weight. So you don't get that unbalanced situation you can get when the position is just reflected through the size and liquidity of the stock. There are, of course, issues with equal weight. You could argue that it gives you a more caricatured picture of the market because some companies are just more powerful than others. So when you make a very powerful company, like a tech company, equal weight to far less powerful company, then it is a bit, it's very caricatured. But anyway, looking here at these two, when we go here to performance, year to date, RSP is beating the S&P 500, the SPY ETF. Looking at beta, it actually is a bit higher for the RSP. Price earnings is also a slightly higher. Dividend yield 1.28% versus 1.22. When we look at the holdings, so here you can see that the weighting is just very different. So here, as an example, Apple is on top, 6.57% with the SPY. And I think we have to just scroll to even find Apple here. So where even is Apple for this? Here, I finally found it on number 27. Okay. So Apple is 0.18% of the RSP ETF, while it is 6.57% for the SPY ETF. So huge difference. We also see that here in the sector breakdown, we get a very different structure. The thing is that, even though the RSP is more, well, obviously more evenly balanced than the SPY, what we found, with the dividend yield and, the price earnings, it wasn't really. I think I would just give this slightly here to the bears, not in like a big way, but I do think that the people that look at fundamentals, they might just opt for the SPY instead of the RSP. So here are correlations, long-term weekly data points. We have 98% with the SPY ETF, 8% as well with WET, the total stock market ETF, 44% with the 10-year yield, and minus 45% with the 20-year Treasury bond ETF, the TLT. Daily data points, 97-ish% with SPY, 92% with VT, minus 60% with the 10-year yield, and 65% positive with the TLT. So what happens to... So we could, of course, look at the SPY, but SPY and RSP are very similar, so we might as well just look at the VT. So this is the total world stock market ETF. We see, a massive rounding top here, but this is, a very developed rounding top, and you can see that throughout it usually has these rallies. So given that we have been down 1, 2, 3, 4, 5, 6, I mean, quite a few weeks here in a row, 7 weeks down, it shouldn't come as a surprise, given that we also are at, RSI support, that we get at least a bounce. Very much to be expected. Do we have data here from the global financial crisis? Yes, we actually do. So if you look at, this waterfall, 1, 2, 3, 4, let's count 5 weeks when this ETF was down very aggressively. But then we did get, a bounce, an attempted recovery. So it is completely normal for that to happen, and it would be a bigger surprise if we did not get at least a bounce at these levels. It's a question of probabilities. That's basically it, because you have to ask yourself who is sitting waiting to sell at these levels, and what kind of bears are waiting to enter new bearish positions at these levels that would add more selling pressure. I think there's a much higher probability that quite a few short sellers are sitting on pretty nice profits now, and in order to close out a short position, you have to buy back. So that is one of the ways you can get, buying pressure. Here is the relationship between, the equal-weight S&P 500 ETF and the total stock market ETF. You see that our RSP has been outperforming WET for quite some time. Looking historically, at RSI, we do see that RSP can actually go substantially higher in this in regards to outperforming the WET. If we look a bit at the seasonality here, so in green over the last 5 years, and blue over the last 7 years, and red over the last 10 years, the RSP has a clear tendency to outperform the WET. Okay, so now let's look at the relationship between WET and let's take gold, because people like to flee into gold during times of panic in the market. Let me see whether there are time cycles here. There are obviously time cycle-ish behavior, but yeah, I mean, there is some consistency to these time cycles. They are not super clean, but interesting. The time cycle suggests decline for the WET, meaning that the total stock market it has a tendency, it is more likely to underperform gold, which means that gold will outperform. Let's look a bit here at the seasonality for the pair. Looking over the last 5, 7, and 10 years, the VT does have a tendency to outperform gold. However, looking specifically at the period between 7th of June to early July, we do see that the VT has a tendency to underperform gold, from a seasonality perspective. In terms of relative performance, we did have a pretty strong relationship with the VT. We also had some interesting seasonality data. So I think that there's a pretty decent probability that we at least will get a bounce at these levels. A key line in the sand here for this thesis is 100 weekly moving average support, and also we did see that we were at support on RSI. So we end up with a score of 2.5, so the data is more favorable of bullish than bearish positions. A very interesting thing we saw when we went all the way back to the global financial crisis, during that housing bubble, the 100-week moving average was a huge arbiter. When it became resistance, that is when it basically was very official that we had a full-blown bear market. Given that we have had so many weeks now in a row of just going down across various stock market indexes, it does create a situation where from the perspective of a short seller, you will be concerned about creating new short positions, because there's always risk, right? You need to do that risk reward analysis. And when you are very oversold on quite a few indexes, you feel less comfortable as a short seller. As a matter of fact, you are way more likely to tighten the stop on your shorts, meaning that you can get this not necessarily a short squeeze, but you can definitively get a situation where quite a few short positions are covered, which means that they add buying pressure to the market. On top of it, you could of course have bulls speculating on some low as well. So I do think that there's quite a few reasons now to expect some bullish action from the RSP. But it is of course a possibility that we will see a total collapse as well. That is why we always use stops and always have a market neutral portfolio.